Hey everybody, welcome to Space Finance. Today we're going to talk about how do you start investing right now, 2021, in the most, I would say there's two ways. One is a safe way, and the other one is like a little bit more aggressive, a little bit more risky, a little bit more volatile. So I'm going to show you today the very basics on how do you create a portfolio that either it satisfies the needs that you have for either way that you want to invest your money. Either you want to go ahead and put your money in dividend stocks, meaning you just put your money there, the companies pay you quarterly dividends, some other companies pay you yearly dividends. Dividends are pretty much like the companies are paying you to invest their money, your money on that company. So essentially speaking, they usually pay a percentage. So dividend portfolios are what we're going to be talking first, because I've created a portfolio for you that you can follow on the M1 Finance. M1 Finance is a brokerage, same way that Ameritrade works, the same way that Fidelity would work. But I really like M1 Finance because it allows you to create your pie, your fund. You pick your stocks, you see the percentage if you're doing a dividend portfolio, and it's really nice. So I'm going to cover that, and then I'm going to cover a really quick, I would say, non-aggressive, long-term, kind of like 7 to 10% yearly returns that are more index funds. So the index funds is like if you don't want to sit down and pick like all the build your portfolio, and you don't want to pick all the stocks, then you would just put money on like the Dow Jones ETF, the S&P ETF, and so. Today, like I said, we're going to jump into the dividend portfolio. How do you create one? How do you pick your stocks in M1 Finance? And then just do, I'll show you the ETF kind of like portfolio, which is like, you don't want to pick your independent companies. So right here, I'm just going to show you, I have created the dividend stock for 2055, meaning that I'm going to leave this thing for like the next, until 2055, and then the index fund I'm going to leave it until 2050. So essentially speaking, just like 34 years that I'm looking for, like, to have the money there. It's money that I really don't need right now. I mean, it's just I'm going to invest it. The real estate market is like, I really like real estate and the stock market, but the problem is real estate is really, really expensive nowadays. So I'll rather just put my money right now in index funds and dividend stocks. So let's jump into the dividends one. So this is M1 Finance. This is the M1 Finance platform. If you don't have an account, go to the link down below, and you'll see a link where you can actually create an account, and it gives you stocks, a free stock, and it gives me stocks. But obviously, it's just like if you want, right? So what I'm gonna say is this is how it looks. You can go to the link that I shared with you guys, and I've already split it up into 21 holdings. This is the 5-year performance. It's 133%. A 1-year performance is a 42%, which is a lot because, like I said, normally a normal return it's 10%, but I'm this is very safe, right? Like in the 5 years, you double your money, you almost double your money, pretty much. So that's one of the things I wanted to show you. It's very nice how you edit it, and to create it, I'll give you the link, but basically you go edit, and then you simply add all the companies. So which companies do I have here? So because I'm looking for companies that really have dividends, that pay dividends, and are safe companies, I've have 21 companies that I've done my homework, I've done research, and I really think that these are companies that are going to continue to grow, especially now that we have some crazy, everybody's out. I don't know if you've gone out on a Friday or on a Saturday. The consumer demand, it's going to explode in the next 3 quarters. There's people spending money like crazy. People are just like out. And they're just, it's mayhem. People are just spending money. So what do I want to put my money in? Is I want to put a balanced amount between banks, consumer like tech, and so energy and so on. So I have Apple for sure. All of them are 5%. Some of them are 4%, but because I wanted to even it out, I have Apple. Great company. I don't have to tell you guys anything about it. I mean, it's just you don't trade Apple, you pretty much own Apple. Second one is AT&T. AT&T is a great company that pays a lot of dividends. I mean, this company pays 6.75% of all the money you have in this, yearly. So, if you have $1,000, they literally pay $60 a year, $67.5, dollars a year. So it's a good company. However, it hasn't had a good performance, I would think. But because the stock price goes in direct proportion of the dividend, it doesn't really matter because you're making a return. The next one I have is Blackrook. This is a great company. It's like they just do. It's a financial institution similar to like Goldman Sachs, and these people manage around $8 trillion, and that's insane, right? Like their market cap is $131 billion. Their 5-year, you could see it in here. It's a 5-year returns 174. It's a great company to own. Best time to buy would have been in March, but a lot of people missed it. You can, it's just what it is. They pay 1.73% dividend a year. So again, for every $100 you put, they pay, essentially speaking, $1.7. And I believe this is every quarter. I have Caterpillar, the same thing. This is a company that pays $173 yearly. I have Chevron for energy. I have Coca-Cola. I have Exxon. It's the same thing as Chevron, but Exxon pays really good dividends. It's like 5.76. I mean, I really recommend buying this thing at the levels it is right now. It dropped insanely. I think it's going to continue to go up as demand goes up. Chevron, Exxon, the same thing. Johnson & Johnson, I mean, it's the future. This one pays really good dividends. It hasn't never failed to pay the investors dividends. That one's good because of the vaccines that it's been putting out. JP Morgan pays 2.19. This is really good. I mean, the 5-year return is solid. That's a good company to put your money in. I have Lockheed Martin. There's nothing I gotta say about this company. It pays 2.5, and it's been crazy good returns. It's like you probably double your money. Lowe's, McDonald's, Microsoft. I got Pfizer because I want more exposure to dividends too. They pay 3.8, and then they also have steady returns, 43%. I got Simon Property Group. I got Verizon. Simon Property Group is like, they own all the malls. So if you go to a mall, they're probably, Simon Property owns them. So because all the economy is going to reactivate, I think it's a good play. I got Verizon, Bank of America, Broadcom, Procter & Gamble, TD Dominion Bank, and then Unilever. All these things makes me a dividend yield of almost 3%, or just over 3%. Expense ratio is 0. If you've had this money, if you put in $1,000, okay, a year ago, okay, May 2020, and you bought these companies with the dividends they pay, without the dividends they pay, you made over 43%, so $430. However, now you got to add dividend yield, which adds more to it. So if you had $100,000, you probably made $42,000, and then you take 3% of that dividend. So that's a chunk, right? Like if you do the math, you put in 100,000 times the percentage, right? 0.02928. That's 0.2%. It's like $3,000 a year just to dump the money there, plus the $42,970 that you made. You made $45,000 on a year just by putting in $100,000. It's almost double it's 50% gain. It's essentially speaking good. So you see the dividends kind of counteract any kind of like fluctuations, but then they add to the stock price. So I think this is a good chunk of, you don't want to put too many stocks, but 21 is good. 21 stocks, you pick the stocks, you can get the list. I'll send you the link. The link's going to be down below. For the 2055 dividend fund. This is going to be my investment in the next quarter or two, because I think all these companies are going to get positioned to gain in the markets ahead. Inflation is going to go up. So all these companies are going to benefit. Coca-Cola, Caterpillar, AT&T, Apple. Everybody's gonna go to McDonald's. Everybody's gonna use Verizon. Communications are key. Unilever, they save products. Everybody's gonna come outside. You know, the malls are gonna get full again. And I was reluctant to add some of the ones that have been canceled, like Boeing and then Carnival Cruise Line, which I might just see. Like, I really like Boeing, and I think I'm gonna add it just to show you how you add it. So you go here, you find Boeing, for instance. They pay 0 right now. Let me find one that pays the dividend. You could dividend, and then you could find by dividend, right? And then you just scroll down to the one you really like. But I'm just gonna go like by market cap, and I'm gonna see which one do I have, which one do I don't have over there that I want to add that has a decent amount of dividend. Visa is good. I like Visa. Let's add Visa, and then let's make it 25. I think MasterCard is probably gonna be, you know, I don't know. Let's see. I think Walmart pays a decent amount. Visa definitely. Let me see what else. Disney don't pay. The Exxon I already have. Adobe, Intel. I don't like Intel. Cisco, AT&T we have. Pepsi, Chevron we have. UPS, McDonald's we have. Texas Instruments, Citigroup, we have a bank already, so I don't want to add that. Hey, Honeywell is not a bad investment, I think. Where is Raytheon? That's a good company to buy. Raytheon, yeah, here's. I'm gonna add Honeywell just in case, because Honeywell has 1.6, but it's been going up massively. This is one of the companies that it was perfect to buy during the crash. It's just crazy. This one, I'd rather add that guy, and IBM is good. Let's just see American Express. Let's check this ones right now. Let me add them here. So let's just do this. Let's just rebalance. Select all. Oh. No. Yeah. Let's just do it again. I don't wanna delete those. So Visa. Where's the other one? Honeywell, Raytheon, IBM, and American Express. So you select, you equalize, you add. Oh no, I'm sorry, I already added. So let's go back and you save it. Confirm. Yep, so that's it. So as a 2.7, it went up a little bit. And we have balanced this out with 26 holdings. But I wanted to see something between Honeywell and Raytheon. So Honeywell has had on a yearly 65 and 125 over 5, they pay 164. Raytheon, which in my opinion is, I think, a little bit better of a stock, hasn't recovered there yet. I think it has a lot that we can gain from it. I think Raytheon is the way to do it. Look at this. This is great opportunity to buy this thing. It was 150. Yeah, we're removing Honeywell and we're gonna add Raytheon. The Honeywell goes out, you remove it like that, then you select, equalize, save. That's how you do it. And that should make a 25 holding. Very, very organized. This is perfect. So I'm gonna go back to invest, and I'm gonna edit this, and I'm gonna remove my stock fund, because I really don't want to do that, and I want to actually do top stocks. I already have that. I'm just gonna select, equalize. Let me just say 70, 30, and I'm gonna save this because I want to do it this way. This is going to be only for index funds and these two guys, dividend funds and index funds. And then on the index funds, this is what I was wanting to show you. I only have 3: QQQ, the Dow Jones Industrial Average ETF, and the S&P 500 ETF. This is all you need. You don't need anything else for dividends. If you have these 3, solid. And then for the dividend, if you have this 25 that I've just showed you, solid. No need for adding anything else that you need to add. So start putting your money here. I think this is a good opportunity for you to show that you have an ability to create your own portfolio, to manage your own portfolio without paying a ETF service fund. Like when you do things like this that we just did in M1 Finance, you are your own manager. You control the money and which company you're gonna put it on. These are solid companies. These are companies that have been in the Dow Jones and the industrial S&P average ETF for years, and they're gonna continue to grow. Things are gonna change. They're gonna have to innovate. But this is a very solid way to invest your money. My recommendation is, folks, that you continue to do research and that you are very, very intelligently picking which stocks you're gonna put in your portfolio based on the research that we just did. Look at the market cap, look at the earnings reports, look at the actual growth that these companies have had in the last year, 2 or 5 years. And then look at their earnings and look at their revenues. Look at the revenue growth. If the companies are innovating and they have good revenue growth, then their ability to actually keep growing, it's gonna be high. It's gonna be more than what you would think. We're very lucky to be living in these times. I think this is a great time to live right now. We have a lot of technology coming up, so this focus a little bit more into the safe kind of investing. There's more growth value. I'm gonna make another video about investing in QQQ and the actual the tech sector by itself. But folks, I think that if you do this, your money is gonna be safe. And if the most important thing is to be diversified, don't put all your eggs into one basket. Split them up. And M1 Finance allows you to do that like this. And then you just add the money in there, and it automatically it's gonna start putting the percentages of all the money that you put in on each one of these. So folks, if you have questions, let me know, and see you later.